All right, what's going on, guys? We got about 2.5 minutes until we get this thing going tonight. So just hang tight for a sec, and we will get underway shortly. All right, that is the timer. So let me exit that out, and let's get this thing underway. Go into camera 2. There we go. All right, so let's get this thing started. It is a little last second notice stream, so if you're watching the replay, no worries. Don't expect to have a ton of people on live tonight. But welcome back to another week of our weekly stock market scan, recap, research, whatever you want to call it. Last week that we just had was a tough one in the market. We'll talk about that shortly. An insane week. But if there really is one takeaway that I could offer after last week, it's that there was a little bit of a disaster in a sense, right? We closed SPX at all-time low, not all-time lows, but lows on the year so far, and our account balance is far above the lows on the year. We've had big swings down or big downturns before in the market, like in January and April, and we were much lower back then than we are right now. So in a sense, our risk mitigation is going well. It definitely is a little bit frustrating that we were kind of knocking on the door of going profitable in what's been a historically difficult year in the market. But that's all right. We've got all the time in the world to make it back. Patience is a virtue with this strategy, and we have all the time in the world. And I'm very confident that even though we did have a little bit of a bump in the road last week, we're going to be able to right the ship and hopefully get things back profitable by the end of the year. So let me pull the screen up. We could talk about how we are going to do that. Put myself back in the bottom left. Let's get into it. So scrolling back up here, we lost about $5,300 last week, which is never an outcome that we want, especially when the market was only down 1.42%, meaning we underperformed by 1.67%. So, never great to underperform. It's okay sometimes if we lose money when the market loses money. That's just going to happen sometimes when you have a decent strategy. But we never like to underperform. So why did that happen? And I guess for a little bit more context on the year, this is kind of the stretch we're on right now. I was really working on getting that 918 loss back, and we were close to getting it back, but a little bit of a speed bump there. But as far as performance against the market, since that's something that we've highlighted, we're actually looking just fine, to be honest with you, right? We're moving back up towards, keeping our head above water a little bit here. where if you look at the S&P 500 or the NASDAQ line right here, those are moving back to lows on the year. So back when they were this low at the end of June, kind of beginning of July, our account was down here. Now we're much higher, and they haven't made much progress since then. And if there is one thing I could point to for encouragement as far as trends are concerned, right? We remember we had a really big dip in January and we had a really big dip in April. That came with a really sharp drop in the S&P 500, both here and then right here. We had another really, this is honestly, if you're looking at the chart, probably the sharpest, most sustained drop of the year. But we haven't had that catastrophic result yet. So if we can build back from, how we did at the beginning of May, and that stretch from May into the middle of September, if you highlight all these right here, we took on $45,000, and that was over a 1, 2, 3, 4-ish month period. So we have we have 3 months left in the year, so not quite 4 months. But if we can make 45K back in 4 months on just a slight recovery right from the S&P 500, then if things flatten out from here or even start to rebound for us, all the confidence in the world that we can make this little jump we need to get back profitable in what quite literally has been a historically bad year in the stock market. But let's talk quickly about what went wrong last week. And there was really one big thing, or I guess one big area I think that we made a mistake. And I've got a blog post that I'm halfway through writing that I think is important to talk about, because there are about 3 mistakes that I could isolate over the past 3 weeks that have cost us about $12,000. And if you could make mistakes of that magnitude in a market like this and still, not completely fall off the face of the earth when you've left basically 12 grand on the table, I think it really speaks to the effectiveness of our core strategy. But one of those mistakes last week was how we hedged our overall portfolio. Now, we like to hedge our portfolio with, SPX call credit spreads, because those are going to make money if the market goes down, stays flat, or only goes up a little bit, right? Those are only going to lose us money if the market shoots up. And that's exactly what happened on Thursday, right? So if we want to pull up the SPX chart, and I made the font a little bit bigger on Thinkorswim this week, so hopefully it's a little bit more visible. But for those of you who have been following the market, you know exactly what this is going to look like, right? We knew that our fate last week was going to come down to what happened with CPI. The CPI result was less than ideal, and as a result, the market gapped down at open. Now, when the market gapped down, we had some big decisions to make. The first of which is we always want to keep in the back of our mind that things can get worse. And if we look at the SPX chart on a 3-year basis, we've seen in so many individual stocks this pattern of stocks falling back down to their pre-COVID peak. For SPX, that's right around here at like the 3,400 level. So I want that number in the back of my mind when I'm investing and looking at where the market could potentially move from here. So if we did go back to that 5-day chart and looked at, where it opened on Thursday morning, SPX opened at 34.9158, or I guess it opened a little bit higher and then started to turn lower. So, we broke under 3,500, albeit briefly. So in the back of my mind, I'm thinking, okay, 3,400 is potentially on the table. And again, things can always get worse. And that's one of the biggest things that we kind of ignored back in January when we made some mistakes and had our biggest loss of the year. So it's okay to make mistakes sometimes, but I think it's important to not repeat those mistakes. Now, we made a little bit of a new mistake, but let's talk about how we got there, right? So when we opened really, really red on Thursday, we knew that, okay, things could potentially get worse, so what are we going to do? We did 2 things, and I think this is where the mistake lies. The first thing that we did was we had this TQQQ, that's 3 Qs, there you go, TQQQ position, where we had 1,800 shares and we covered those with 20 strike covered calls. Now, I think TQQQ, if we pull up the chart here, this might help contextualize this discussion a little bit as well. But it opened at 1632, right? And our covered calls were at a 20 strike. So we figured that is a long way away, especially considering, 1, we gapped down, and 2, the previous 3 days in the week on Monday, Tuesday, and Wednesday, we never touched 20. So we said, okay, let's just roll these down. Because look, if things get worse, we want to get a little bit more money out of these covered calls. And if it finishes above 17, we can at least rest assured that the market has rebounded a little bit and we're not going to be looking at like a disastrous week. So that's exactly what we did. We rolled our 20 strike calls down to 17 strike calls. And what that did was it enabled us to collect 37 cents more of premium, which over 18 contracts is about $650 of premium. So we got $650 from this hedge that we created by rolling our covered calls down. Now, I think the issue we had was, look, we had these TQQQ shares. They're going to move similarly to SPX because TQQQ is a leveraged tech index, and all the indices tend to generally move together. But when we rolled down to 17, that was in itself a hedge because it gave us $600 more no matter what, and capped our upside a little bit. What we did on top of that, though, was we also sold these SPX 3500 or 3550, 3555 call credit spreads, meaning that if the market jumped up, these would lose. But we wanted the market to jump up, so we viewed it as a hedge. Now, the mistake is this. If these hit max profit, we were only going to make about $280, $290 on these. With this TQQQ position, we granted ourselves an additional $650. So what are we doing here with SPX in a trade where we're only looking for $300 of upside, and we know we have more potential downside than that? That was the big mistake we made last week. And I don't think there was anything wrong with how we managed it, but I think the fact that we were in it at all in the first place was a mistake, and this ended up being a roughly $1,900 loss. So that was a tough one to stomach for sure, but one of those things where, if we have a position like TQQQ, and we, honestly, in the past, we haven't, so it's one of those things where I never truly considered how intertwined those two things are and how similar rolling covered calls on TQQQ down is with opening SPX call credit spreads. But now that we have those two positions going, it's tough to make quick decisions in the heat of the moment sometimes, but we now have this experience we could look back on to say, okay, we remember the last time this happened. This is the correct move going forward. So yeah, we made a mistake, but the important thing here is that we identify what we did, we learn from that, and that we don't make the same mistake twice. So that really was the only thing that I think we did terribly last week. We got really unlucky with DraftKings, and DraftKings had about a $3,100 loss for us as that thing dropped like 25-30%. We could take a look at the chart here and see what we think moving forward. But I mean, this is tough to get out of the way of, right? You have a stock that opened on Monday morning at $16.77, and before the end of the day on Friday, it was pushing $12 a share. So that's like a 25-30-ish% drop in 1 week. And honestly, there's not a lot of strategies on earth that can handle that drop. But with that said, look, $3,100 loss. If you look at what DraftKings had done for us over the past few weeks, right? We made $1,400 on it the week before that. We made $1,900 the week before that. So I mean, even on a 3-week trailing basis, we're positive on DraftKings. So I like the stock. I liked it at 16, 17. That means I love it down at 12. However, it's a little bit sketchy, this price action with no news. There was a little bit of news in the sense that, this big green candle they had overnight was off the news that they had a partnership with Disney. And then that was given back pretty quickly, unfortunately, which leads me to believe that kind of under the table, that partnership may no longer exist. Now, whether or not that's true or not, I don't know. But, that's the kind of thing that you see happen sometimes when stocks make moves like this without any corresponding news. Let's see. We've got Mahir in the chat saying the Niners stole all of his money today. I, unfortunately, was at the 49ers game today, rooting for the 49ers, and that ruined my afternoon. That sucked. They lost to the Falcons by 14, and I had the pleasure of witnessing that in person. Big 49ers fan. We've got the George Kittle bobblehead. Let's go to the full screen right here. Hold on. Full screen. Where we go? We've got the George Kittle bobblehead right here. He unfortunately did not get the job done today. Tough to see, and that's actually the second 49ers game I've been to this year. The first one was week 1 against the Bears, and they also lost that. So I will not be going to any more 49ers games this year. Back to the discussion. So let me pull back Thinkorswim. But again, the idea with DraftKings is I think maybe behind the scenes something's going on. But look, even if it does come out that there isn't necessarily a Disney partnership, this more than prices in that bad news to me. If we want to look at some longer term trends, we've bounced off this 11-ish level a couple times. So there could be a little bit more downside. But with that said, we have prepared ourselves for that downside by selling some 13 strike puts, and we lowered our position size, right? Typically, when we manage these positions on a week-to-week basis, we want to keep ourselves in the game, so to speak, where we could make our money back. But like we just showed on a 3-week trailing basis with DraftKings, we're actually positive on the trade. And if you look at our overall trade, this huge ledger of trades where we've run DraftKings through the HT wheel, We're only down about $1,900. So if we make, if it finishes above 13 this week, we're only gonna be down 900. Our break-even price is like 14-ish. That's okay, right? We could bend, but we don't want to break, right? It's easy to make back $1,000 loss, but if we keep this heavy position, and again, in the back of our minds, we think SPX might go to 3,400, but we don't want to get crushed. And there's a lot going on this week in the market, and we'll talk about that a little later. But that's kind of why we've taken the foot off the gas on a couple of these positions. But that was kind of the two big things last week, right? So at DraftKings, I think that's just kind of rotten luck. I don't think we did anything wrong there. And then SPX, we made a mistake there. And those two alone, DraftKings and SPX, that's $5,000 right there, right? So 1,900-ish of a mistake, and then, $3,000 of bad luck. And that's the extent of our losses. So even though the market finished red, if you look at a lot of our, individual positions, they actually kind of did well. SoFi made money for us. AMD, we didn't quite make money, but we limited our losses on a week where AMD dropped. Affirm, we made about $450. That was nice. Unity, that first position we got into was a loss, but as the stock drops, we scale in further. And that scaled in position brought us $294 of profit. So we made $9 off Unity last week, even though it dropped a little bit, right? And we started playing Unity. This is another good point that I think I want to bring up here. Notice that we're on the 31 and 29 strikes this week. And if we sum up all of our Unity trades over the last 3 or 4 weeks, we've got one right here with 30.5 strike puts. The week before that, I think we hit Unity for a 31 strike put. And then the week before that, we hit Unity with 33 strike put. And did we do it before? We did, with a 35 strike put. So this is a great example of how we can roll our positions from week to week to week, right? The week of September 11th, Unity, we started with 35 strike puts. And Unity on this date was trading at, 35.54. Fast forward to today, where Unity has continued to have this skid downward, and it closed last Friday at 28.98. But look, that's a $7 per share drop. We've ridden this thing from this 35-ish level down to 29. And if you look at the sum of everything we've added up over the last 4 or 5 weeks, that's $1,200 of profit. So if you have these opportunities like this where you identify really nice premium at solid strikes, you can make money despite the fact that the general trend over the last month on this is down. And if you look at what we've got set up for next week, we're going right back to the bank on Unity. If I could quickly flip over here, with the 28 strike put. So again, we've lowered that even further. And we've got another potential $470 in profit on tap with that one. So that's going pretty nicely for us. But yeah, again, a lot of these smaller individual positions, the strategy we have of scaling into these positions has weathered the market very, very well, right? Ford, that one dropped on us, the 12 strike put. We lost a little bit of money, but we took that opportunity to scale in with some 11 strike puts, made $70. And look, $70 is not an insane amount of money, but when the market's red, any sort of green overall from a position is a win. And if we cut out some of the mistakes that we've had, like with SPX where we messed up and lost $1,900 right there, MindMed where we had way too far out of an expiry, we lost $1,400, and then PGY where we were messing with the SPAC that we just should not have been touching. That's $7,340 worth of mistakes right there. And I think if we go a little further up, we also had a mistake with SPX. Similar with that the discussion of the hedge, right? So I think 2 weeks ago, there it is, we essentially lost $4,000 on SPX on a Monday, Tuesday. So all of those mistakes right there, and again, SPX, PGY, MNMD, these are all outside of the core positions. These are all things we've kind of tried to do on the side a little bit, and we made mistakes in the way we went about that. That's $11,352 worth of mistakes, and that's enough to have put us profitable on the entire year, despite the fact that the S&P 500 is currently at a yearly low. So that's why I'm confident that once we identify those and clean that up a little bit on a week-to-week basis, the core strategy is handling the drop in the market very, very well. But again, that's what happened last week, right? Uvxy is an interesting one to talk about really quickly before we get into next week. This has been going really well for us. I need to update this to say week 5, and I need to put a bottom border on this so it doesn't look completely terrible. But yeah, these are the weeks that we've completed so far. These are what the returns look like. And honestly, so far, so good. We got off to the wrong, or I guess we got off on a bad foot with this one. where we lost 430 the first week and 160 the second week. But I really liked the idea behind this, giving yourself a really wide break-even range. And UVXY sometimes can get very, very volatile. But so long as we give ourselves these large break-even ranges and put ourselves in positions where there's defined risk on the upside via these call credit spreads, I think the value proposition is very, very nice. And we've seen that play out over the last few weeks. So even though we got ourselves into like a 590 hole off the bat, we made 1140 the week after that. We made 130 on it last week, and overall over the past month we've made $680 off this position that takes 3 seconds to set up on a Friday, and then you check it again the next week. And this week we've got a similar value proposition, right? We've got 12.5 strike puts combined with 13/14.5 strike call credit spreads for a potential max profit of 770 lands between 12.5 and 13, but we're going to make money on this trade overall if UVXY finishes between 1173 and 1377. So giving ourselves these really wide ranges of profit is, I think that's something that's going to lead us to be very successful long term with this UVXY strategy. So we're going to continue to follow and monitor that one as well. But that was last week. Tough bump in the road, but full transparency. Look, it happens. Important that we share the mistakes, important that we identify the mistakes that we made, and most importantly, keep those in the back of our minds so that we don't make the same mistake twice. But to not dwell on the past too much, let's talk about what we've got going for the upcoming week. And the upcoming week is, I think, going to be a very interesting one, right? I think the last couple months of this year in 2022 are going to be very pivotal. There we go. What are we? 23 minutes in, already messing up my words. But they're going to be very pivotal. So next week, and I think something worth calling out here, is going to be the first week of earnings season again, as companies report, I think, Q3 earnings. So if we take a look, I've got the little earnings calendar right here. You probably can't see it too well. It's pretty far away. But we've got some big names starting to report earnings, right? We don't have the Apples, we don't have the Amazons, but for some of the stocks that we're holding, there is a little bit of a sympathy type effect, meaning that if one of these stocks reports bad numbers, the assumption is that some other stocks are going to report bad numbers as well. And I think that's really going to get kicked off Tuesday after market close with Netflix. We've got Tesla coming Wednesday after close. We've got Snapchat Thursday after close. And I've got an interesting idea for that one as well. We'll talk about it a little bit later in the stream. But what we will remember, and I think why it's important to point this out, is that we remember Netflix, right? I mean, of course, we remember Netflix, very popular streaming service, but we remember it in the context of earnings? Because the last time they reported earnings, they fell off the face of the earth. Let's see if we can go back to the 180 day. I don't know if it was last time or 2 times ago. It was 2 times ago. It was right here. So back in April, and this is what led the big skid, right? If we go back to our profit tracker, we talk a little bit about that time in April where we threw away 29 grand. That sucked, and this was the first kind of domino that fell when all that started happening, right? So Netflix reported these terrible, terrible numbers, and that had some big ripple impacts over kind of the growth area, right? So if you look at 419, you could look at any other stock too, like 419. 419. You've got these big red candles as the market began to sell off in that area, right? So you could similarly look at Snapchat, I think 419. Where's 419? Here's the big red candle after 419, after Netflix reported earnings. And then, they had their own earnings shortly after. But it's kind of like the canary in the coal mine, so to speak, where a lot of analysts look at what's going on with something like a Netflix, since they're the first, company to start reporting. And, personally, I think guidance is going to be pretty poor for a lot of companies. We've seen a pretty big contraction in market values just based off of interest rates rising, and I think the next domino to fall is going to be the earnings of companies falling, right? Because a really common way, and I think, the most prevalent way of valuing stocks is on a price to earnings ratio, right? So if we go S&P PE ratio, you're going to see the average PE ratio of the S&P 500. You're going to see right now it's at 1810. And, anytime you have a decent drop in the market, you see these multiples get contracted pretty sharply. Here it is at the front end of like 2000, where the multiples were sky high, fell back down to be more in line with average. But throughout the course of history, all the data we have, the average PE ratio in the S&P 500 is 16, roughly 16, right? So we're still a little bit above that, and I don't think there's necessarily an issue with that. But typically when these things snap back down, like if this snap back down, this goes to 15. If we get back to where we were just after 2010, and again, not a horrible place to be, right? We're not anywhere near where we were, a year or so ago when we were looking at a PE ratio in the S&P 500 above 35, which was outrageous, and we've seen a lot of those valuations get crushed. Case in point right here, we've got Snapchat going from 83 to 999. Things like DraftKings going from 74 to 12. Things like Shopify going from 176 to 26. So that's something we want to keep in the back of our mind as well, where the S&P 500 PE ratio is. Now, you might say, okay, all is good and well right now. I think this is a fair PE ratio. I think the prices are good. However, if earnings season comes along and companies update their guidance, one half of that PE ratio formula is going to get crushed, right? The earnings. So if companies start forecasting lower earnings in order to keep this 18-ish ratio or stay in line with, the traditional 16-ish PE ratio in the S&P 500, the P part of that PE ratio is going to come back down, right? The prices. So it's going to be really interesting to see what forward guidance looks like. And a lot of these companies that are reporting next week are going to be kind of the first little preview that we get of what some of the larger companies are going to be doing as far as earnings forecasts are concerned, and I think we're going to see some decent moves in the market. All that to say, I've taken the foot off the gas a little bit, right? We're back down to 81.09%. Now, typically when we have a bad week, and not that this is a great example of position sizing, what we did in January, because we started at 175, right? But after the bad weeks, we want to scale further and further in. I think at one point we got to 216% fully cash secured. That was horrible. We're never doing that again. But moral of the story is, as far as our position sizes are concerned, we haven't really scaled up that much. And the reason being is I really want to see how these earnings shake out next week to kind of give me the green light to play a little bit of a bounce, right? So if we look at SPX, again, we always want to keep these macro trends in the back of our mind. Yes, I think there's potential downside to the 3,400-ish level, which is down here, but in general, look, on a 180-day basis, let's pull this back up. RSI is still a little bit oversold. We're at a really nice level of support at this 3,600 level where we've already seen it bounce previously. And if we could bounce off of it again, looks like decent upside where I think we can start chasing back to 3,700, even though we did that very briefly last weekend off what was one of the crazier moves that I've ever seen intraday in the market. But that's what we're looking at, right? I think we could definitely, push back up towards these levels in the near term. But earnings season is really going to be, I think, the big determining factor in where the market moves between now and the end of the year. Now, there have been several forecasts that have the S&P 500 finishing somewhere up around here or around here at the end of the year. And we always want to remain slightly bullish in our portfolio. So we're going to, play that, but we also want to be mindful of potential downside to this big bad red line right here. And if we do get down to this red line, that's when I'm going to start to get pretty aggressive. But honestly, no need to get aggressive right here, right? Last week was terrible, right? We lost $5,300, but we're going to make at least $4,500 back just if the stocks that we hold this next week are flat, right? So we want to have these smaller positions, one, that enable us to make this kind of a return if things are just flat, and two, that if we do come down to this red line, which I kind of suspect we may at some point in the future, we want to have the flexibility to scale further into positions, and that's exactly what being 81% of our account fully cash secured is going to allow us to do. So let's go top to bottom here, talk about what we have for the upcoming week, run some scans, and then talk a little bit about maybe a shopping list that we could use to add once something like Netflix reports Tuesday afternoon and we get that proverbial green light to enter into some more positions once that earnings risk of poor guidance across the market is gone. So DraftKings 13 strike puts. Look, we lost a decent bit off DraftKings last year. Last week. We're not gonna try to get it all back right off the bat. I don't think that's really necessary. And again, this is nice because if the stock stays flat, we make $440 off of it. If DraftKings goes up to 13 or higher, we're gonna make $1,000. So there's decent upside on these positions. And the way we have this set up, I really, really like it because look, the market just dropped about 1.42%. I could definitely see us bouncing back up a little bit based off what we saw a second ago in that 180-day chart. So we want to have a little bit of upside, right? So if things go down, we want a little bit of protection, and we've got that protection. If you look over at our break-even tracker, we're above our break-even prices on everything. And if things go down, we want a cushion. But if things go up, we want to make a little bit more money. And just real quick exercise, if this expired worthless, these go worthless, this goes back up to 18, these expire worthless, and like the market has a good week, we have upwards of 7 grand of profit that we're potentially looking at right here. So I think that's a phenomenal place to be, and that would, completely erase last week and then put us profitable overall. And it doesn't take a huge leap for us to get there, right? I think the biggest swing is TQQQ and DraftKings, where TQQQ only needs 43 cents and DraftKings only needs to go up by like 52 cents. Question in the chat: are we bullish or bearish towards December? And honestly, if I really had a conviction on short-term price movement between now and December, I'd be playing it. In general, right, we want to be bullish long-term because there's not a lot of guarantees in the market. And I think maybe on an individual day or individual week basis, excuse me, the market's pretty random. But the closest thing that we have to a guarantee in the market is that it's going to go up in the long term. So as far as how I feel towards December, it really is going to depend on what earnings reports look like. And, talking a little bit about that Netflix, talking a little bit about Snapchat reporting next week. If their guidance is solid and they don't think that there's going to be some huge forecasting cuts based off of some recessionary pressures, I think that's very, very bullish. And the market typically looks for reasons to go up as opposed to looking for reasons to go down. And a lot of that earnings risk and forecast, a lot of people are holding their breath, and I know there's a decent bit of money on the sidelines waiting for that shoe to drop. Now, I think if those go poorly, though, it's going to be a rocky end to the year. But I really do think beginning of 2023, once the Fed finally finishes hiking rates and gets to a point where inflation starts to at least cool off a little bit, and they've finished hiking rates, I think that is the point which the market is going to hurry up and have a nice little bounce for us. And we always do want to remember how the stock market moves in relation to the economy. Like in instances in 2008 where we were in a big recession, the bottom of the stock market, it's important to remember the stock market's very forward looking. The bottom of the stock market did not coincide with the worst of the recession. The stock market bottomed, a little bit before the worst of the recession in 2008, 2009. So even if you are like, okay, interest rates are rising, I'm worried there's going to be a recession early 2023. Well, for starters, we are currently in a recession by literal definition of shrinkage of GDP for 2 consecutive quarters. But two, again, the stock market is not the economy. And historically, in recessions, the stock market bottoms before the economy because it's forward-looking. So that's something to keep in mind. And again, we've seen a pretty decent pullback, right? This is only 180 days. If you look at it on a 1-year basis, decent pullback. We still were at a point. I'd have to make this chart a little bit longer and customize the time frame here. Maybe 10 years would be a little bit more helpful. But look, yes, we had this big drop back down here. I don't think we're getting back into the 2000s on SPX anytime soon. But I definitely think this range is reasonable, especially based on just historical growth over the last 10 years in the S&P 500. I think coming back down here is normal, and it might take us a long time to get back up to all-time highs. But you'll have to remember, all-time highs are now a pretty long way away, right? At 4,800, that's like a full 1,300 points on SPX for us to get back up to these levels. And again, we remember for our strategy, we don't need the market to be just completely shooting upwards. As long as we stabilize a bit or start to recover, that's fantastic for our portfolio, and we're going to do really, really well. And again, we've braved this most recent skid very, very well as well. So I think looking forward, I like where we're currently at. I don't think the market's crazy overvalued right now. I definitely think there could be some short-term pain that we want to pay attention to. But again, as long as we take that cautious initial approach each week in the market and leave ourselves a little bit of flexibility, we're going to be able to handle that very, very well. And then speaking of one of those trades that's been very, very flexible and successful for us is Affirm. We've got 17 strike puts on those expiring Friday. Got about a buck of premium. We're going to try to grab 490 bucks of profit on those. Let's pull the Affirm chart up really quickly. Similarly to when we were looking at Unity earlier, this is another one where over the past month, pretty clear trend down, right? It's gone from 23 to 17. But if you look at when we've been playing this over the past month, last week we pulled about 450 bucks of profit. The week before it, we made a couple hundred more. The week before that on Affirm, we made 890, which was fantastic. But I think that's because we lost a little bit of money the week before that. And then a week before that on Affirm, lost 275. 460 when we're playing the 22p. I mean, we've been playing this thing almost every week because the premium is so nice, right? We started playing this at the end of August, and since then we've made $1,000 on it, right? And you might say, you know, $1,000 over the course of 2.5 months, not insane, but again, the S&P 500 was at 405 when we, I guess SPY was at 405 when we started playing this. It's gone down to 360, which is an over 10% drop in the market. And since then, we have a position we've made money off of despite it looking like this on the downtrend. And that's kind of all you can ask for. A bullish position that's making money in a down market is phenomenal. So again, a firm's been great in that regard. We've got the 17 strike puts lined up for next week. Our break-even price is down at 16, which is, lurking, but a decent bit of cushion right here at 16-ish. So we just sit tight with those 5 contracts. If it bounces back up, it bounces back up, and we take home a really, really easy profit of $490. But if it doesn't bounce back up, we just scale into the trade. We stick to the plan, right? We only started with 5 contracts of a firm because we wanted to give ourselves that flexibility to scale further in if it drops below our break-even price, which is $16.02 this week on a firm. SoFi, the 5-strike put, I think we made money on SoFi last week, didn't we? Yeah, we made $80, right? Nothing crazy, but again, red week, a green position, that's a win. But again, we're going to stick around that 5-strike. We talk about scaling into positions, and I think we have the ability to double down on pretty much everything we're in this week, with the exception of TQQQ, and to compensate for that lack of flexibility on TQQQ, we sold some more conservative 18-strike covered calls on that one. So if it does drop, we've got $1.14 a cushion. That's fine. I'm happy with how that one sets up. Ford going right back to the bank. I'm happy with how this one looks at the 11s. AMD, we're sticking with it, right? We're not entirely going to be able to make back the money on this one, but you'll remember we started this thing a while ago. Let me see, if we put 1016. We started this thing about a month ago when it was trading at 76.15. We looked at a firm, we looked at Unity, where they had some slight declines over the past month. And this one has had a little bit more severe of a decline, right? So look, AMD over the past year, right? This is just the past 6 months, but this thing was at 133, hanging out in the hundreds. Then it started hanging out in the 90s. Then it got back down to 80, and we started to say, okay, I could definitely wrap my head around this valuation and be happy to invest in AMD at these levels. And that's exactly what we've started doing. However, we started in the mid 70s, and it's down to 55. Typically, that's a pretty steep drop for a 1-month period, but thanks to the strategy that we've put into play, our break-even price is now down below 60. Are we going to be able to hit that? We're not, because our gains are capped at 57. But look, if we get back up to 57 this week on AMD, I would definitely consider that one to be a win, because we would take home a profit of $555 and move towards profitability on AMD and maybe set ourselves up next week to get to a place where we're profitable in that position. But either way, one of those things where the golden rule of selling options is only sell options. I guess only sell puts on something you're comfortable taking assignment on and owning. And I think AMD in the 50s, fits that to a T. Unity we talked about, we just keep lowering the strike on that one every single week. Premium's fantastic and makes for some really nice flexibility. Palantir, we stuck with the 8-strike puts, and this one unfortunately fell off a little bit, and this is probably the closest one that needs a double down right now, and I'm happy to do that at like a 7.5 strike for next week, because if you look at that, it's offering about 25 cents of premium, right? And our weekly break even on Palantir, since we sold these for 52, is like 748. So if it's below 748 at any point on Monday, we're going to sell the 7.5 strike put. That's going to directly decrease our break-even price by 24 cents since we've doubled the position, contract for contract, dollar for dollar reduction of the break-even, and get us down to like 725. And I think 725 is a perfectly fine place to be on Palantir. I think it's one of the better, smaller stocks, right? It's bottomed out at this 750 level a couple times, which is why I like this level right here. More recently did bottom out at 720-ish, which is why I like the idea of the double down to get our break-even price there. But in the face of what's been a tough month in the market, this thing's basically dead flat. It's had a decently strong month. Yes, it did get up to 860 and started pushing that. But now that it's fallen back on a 1-month basis, you see RSI start to get back into the blue here, and that happened, a little bit back in September, towards the end of it, September 23rd, when it bottomed to 713 before making just a huge run up to 861. So this is one that I think is worth sticking with and potentially doubling down tomorrow if need be, right? We take a look at futures. They're up about 0.5% right now, which is solid. Always good to start the week on a green note. Shopify, that's another one, right? Just like Unity, same exact strategy right there. The premium on it is great. I think the price point is solid. And again, it's trended down from 33 to 26, decently significant drop. But if we take a look at what we've done over the last few weeks on Shopify, we made $245 on it last week. Did we touch it the week before? We did when we made $265. Did we touch it the week before? We did when we made $190. How about the week before that? Shopify. We did not do it the week before that. Okay, but we started playing this one again. A week of $925, and again, that's $700 of profit over the last 3 weeks on this thing, even though it's, had a chart that looks like this. So really, really nice premium. I think 25 is a good, it's decent price. I would have liked to go a little bit lower because we see that 23.63 low, but really that was one really quick candle wick. We see some better support here at the 25-ish level. So that's where I've entered for the coming week with the 25 strike puts that we've got, and we sold those things for 64 cents. That'll bag us $320 of profit. And again, we start with 5 contracts because if it continues to slide, we have a break-even price right now of like 24.36. Is that right? There you go, mental math. So if it gets below that 24.36 line, which again is down here on the chart, we're very easily going to be able to scale further in and then get that eventual break-even price down below the bottom of that candle wick. So that's the plan with Shopify right there. Again, just happy to keep that one going for another week. And then the last two to talk about here are going to be Peloton, which we have 7.5 strike puts on for the coming week. And definitely we have capacity to double down on that one. Premium on Peloton lately has been insane, right? So one of those things where it's almost too good and you're like, oh my gosh, are we expecting a big move to the downside? But if you look at the call premium, it's equally solid, where if you go like 75 cents out of the premium, you've got, 75 cents out of the money, you've got like 20 cents of premium. If you go 75 cents out of the money the other way, similar amount of premium. So it's not like there's a huge downside bias in the premiums when you look at this option chain. So that's encouraging for that one. And again, it's at 724, which, things have been better. It was down 16.88% on Friday, which is crazy, and another example of just some poor luck that we had at the back end of last week. But that's okay because we've got a plan for it. This thing has been hanging out above 8 for a decent bit of time, so I'm perfectly happy to jump into it this week. Again, with those, where are they? 7.5 strike put, which is going to give us a 7 break-even price for the coming week, which is right around here. And if it gets back down there, look, there is an insane amount of option premium down, even at that level, out of the money. So we'll probably, if it drops down to 7, we'll probably be able to get somewhere in the neighborhood of like 40, 45, 50-ish cents on a 7.5, which would drop our break-even price down to like mid 6s, which is down here and coincides with kind of the all-time low on that one. So we're perfectly happy to be set up in that one. It might be a little volatile. It might be one where if it runs away at the beginning of the week, would be a decent idea to close for a profit. But that's one we're in, and we're fine with that. And again, another one with some upside, right? If it reclaims that 7.5 level, we're going to make a couple hundred more on top of that and take home $510 on Peloton next week. And then Stitch Fix is one we added, one of those kind of like smaller trades, definitely a little bit riskier due to the nature of the company. Not the most blue chip company in the world, which might even be an understatement for that one. But with the 3.5 strike for 20 cents, you're kind of playing a numbers game a little bit, which is famous last words, but look, this is not it's not a SPAC, which is typically what I use that reasoning for. And if you look at the chart right here, we're catching this thing on the 180-day lows. RSI is down into the blue. Last time it got into the blue, it didn't, have some huge green candle up, but it at least stabilized a little bit, and that's all we need. Implied volatility definitely starting to run up a little bit and is absolutely higher than where it's been over the last 180 days. So we like that increase in the implied volatility. And look, our break-even price, we could even blow this thing up over the course of a month. Our break-even price for the next week is going to be like 330 if you take that 3.5 strike, subtract the 20 cent credit we got on that. So I think this line right here is a perfectly acceptable place to be on Stitch Fix. And the reason we love these smaller ones is, look, it's a smaller position, right? This only takes 1.94% of our account, as opposed to some of the other trades we're in where it's maybe taking like 4, 5, 6, 7, 8. So the risk there is low. And even though it's a riskier stock inherently, the return you're getting is very nice, right? Because you're getting a 19-cent return, which is the credit you've received, divided by the amount at risk, which is 331, right? It's 3.5 strike minus that 19-cent credit you receive. So if Stitch Fix just has a flat week or goes up for us, you're going to have a 19-cent return off 331 at risk, meaning that's a 5.7% return on risk. And we know what a 5.7% return on risk looks like on a 1 week basis if you can get that time after time after time again, right? We only really like to target 1, 2, 3-ish%. So a little riskier. We get compensated for that by a much, much larger return on our investment for Stitch Fix right there. And we're not losing sleep over the, quote unquote riskier trade because, it's a smaller position. And then we have that Uvxy position we talk about where that thing has been performing very, very well for us. I love the way the math sets up on this. Need to update the chart here to give you this plus this, and all of a sudden the chart looks even better. It's supposed to look better. There we go. We could potentially, if we hit max profit, be at a 14.5% return right there. Let's talk a little bit about the SPX condors before we get into some quick research for the coming week. These have been fantastic since we've opened them. We've calculated this. We love the expected value we're getting. And so far, things have been working out-ish, kind of in line with our calculations. Now, the only one deviation I would point out is, this goes back to when we calculated our initial SPX credit spread odds. We calculated that we'd be successful roughly 67.5% of the time per spread that we opened as part of these. And what does that idea of rate of success come from? Since we manage these credit spreads by rolling them when the long leg or the short leg are breached, it's just the odds that that leg gets touched during the day. Now, with these SPX spreads, when we only played one side of it, we had a 68.87% win rate across 151 different spreads. And that was almost dead in line with what we calculated. In fact, it was a little bit better, which gives some credence to the idea that playing that idea of RSI and then using that martingale system to double down and have this mean reversion working for you as well works out very well. So that's, I think, why we have this higher win rate here. When we look at the SPX condor, the win rate's a little bit lower at 63.64%. So that means our rate of loss here is now actually, it's supposed to be 1 minus, equals, 1 minus this right here. So our rate of loss is actually 36.36% so far, giving us, again, that 63.64%. Yeah, 63.64% rate of success per spread. Now, that doesn't crush the math, right? We'll see that before we had a $272 expected value per condor that we run here. And even with these actual numbers, it's still positive. It's down to $199.50, and that's a very, very good return. So let's not get that idea twisted. But again, does knock down the expected value a little bit, but still has a very nice expected value that's grounded a little bit more in realistic numbers that we've played. But since we've started doing that, we have not lost a single condor that we have been in on, right? We've had a couple wins. We've had a couple max profits where we roll that initial leg and then both of them win. And if you are new to the stream, new to following us and wondering what the hell we are talking about with these SPX credit spreads, we've got a post on our website about SPX credit spreads. I think it is restricted to HD Premium members, but if you do want to sign up for that, hourglass-trader.com, sign up for HD Premium. First week is free with no financial commitment. So honestly, you could sign up, cancel it, and then read it. But please don't. I would appreciate it if you did not do that. But we've got these condors. They've worked very well, and I'm going to put together a more comprehensive resource about how we calculate all of these so you can kind of top to bottom read through the process of the idea behind the trade, how to manage it, what to do, and the potential outcomes. But that is also in our Discord server, which I could pull over here really quickly. And again, hourglass-trader.com. You can join the Discord server for free. There's a link to do that on the website. But if we look at spreads, we go to the pinned messages. Basically, we've got this whole write-up of how this all works, what potential outcomes are, and how that math works. Again, that's in the spreads channel. Go to the pinned messages. You'll see that right there. But that's what we've got. It's been working very, very well so far. And there are some days we want to do this, some days that we don't want to do this. Example of days that we don't want to do this are like last Thursday, when there's a super volatile event like CPI coming up. Example of when we do want to do this is probably going to be tomorrow when there's not a lot going on. The great part about these is you get in, you get out, you do everything you can to not take them overnight. We've only had to take them overnight one time, and even the time that we did that, it wasn't really necessary. So there's no need to do that, right? And the big risk that we identified for this coming week is going to be earnings and how the market moves in sympathy with guidance. And the idea of you getting into these at like 10-ish, I think 10 a.m. is kind of the sweet spot we've identified to get roughly like a 70 to 80 point wide window of profit on SPX. If you get in at 10 a.m., get out before the end of the day. Earnings happen before the market. Earnings happen after the market. Earnings don't happen during the market. So these condors are kind of exempt from earnings related risk in the market. And that's the only risk we've really identified for the coming week. So definitely going to be hitting some of these next week. We've averaged, I don't even know what we've averaged honestly per win. But that's what the chart looks like so far, right? Off the 6 trades we've done, we've won all of them. And assuming you do this with like a $5,000 account, that's equivalent to a 55.4% return so far, which is it's really been phenomenal, right? And the reason we say 5,000 is because look, the max loss every time you do this is like $1,200. So if you fund an account with $5,000, that theoretically you could take max loss 3 times in a row and still have enough money to continue, and that would be very, very low probability of that occurring. But again, that's kind of the hypothetical that we're using here for calculating the return is off a $5,000 base account, which again, hypothetically, with the SPX condors that we've done so far, has now been built up to 7,770. And I don't say hypothetical because we're not doing this. We are doing this. It's just in my bigger account. I just don't literally have a $5,000 account. We're just doing this as part of the larger account. But again, these are literal trades we have taken and won. I love the way the math works, and we're going to keep hitting these. It can be a little stressful to manage these on a day-to-day basis. And I definitely was finding that out last week. But I think kind of disconnecting yourself from that, understand we've got at least a little bit of a profit base built up off those now to work off of, take a more mechanical approach and try to separate emotions from it. But with that said, that's what we've got for the coming week. I love the fact that, one, if the market stays flat, which is technically what it's most likely to do, we don't know if it's going to go up. We don't know if it's going to go down. The most objective way to evaluate what we've got is how our portfolio turns out if things stay dead flat. We'll take home $4,500. And again, that won't exactly make back everything that we lost last week, but that's okay, right? If we look at our yearly performance, we're still hanging right around breaking even overall on the year, and that's with 2 huge mistakes, right? Between January and April, those 2 months, we lost $70,000. We made a couple big mistakes. But look, transparency is all part of the game. If there's people on streams, people you follow on social media who are trading, looking you in the eye and telling you they haven't made mistakes or lost money at any point during this year, especially in what's been a historically bad year, they're probably lying to you. I think transparency is all part of the game, and managing expectations is super important. But in the failures we've had so far earlier in the year in 2022, I think we could also point to the progress we've made and how we've adapted the strategy to perform better since then. And since then, we've made $35,000, and we're working back towards break even. And again, if we could break even this year, we've accomplished our goal. If this blue line here, which is our performance, finishes above these, which at this point it's going to happen. Hopefully I didn't do anything too crazy to jinx that. But we've accomplished our goal, right? We've always said, and of course we never want to lose money in a year, but if we lose money in a year and the market lost more, we did our job, because our goal is long-term outperformance in the stock market. And that's exactly what we have accomplished, as we've outperformed NASDAQ and the S&P 500 by over 100% each since we started publicly tracking our trades in July of 2020. But let's talk a little bit about next week. And one thing that I want to set up is this idea of a sympathy trade. And this might involve option buying, so pretend you didn't hear this from me. But I think it's an interesting idea that might be worth exploring for the coming week. So if we take a look at Snapchat, let me set the scene for you right here. And Snapchat, for some background information, they report earnings on Thursday afternoon. So if we go to the 180-day chart here, I believe they had a really, really bad earnings. There you go, back on July 21st. Where they took a candle from 16 down to like 10 the next day. That's a massive, massive dip. And again, that was on July 21st. Now, if you look at this, look, implied volatility goes from like 1.2 to 0.8. That's expected, right? It builds before earnings, comes back down after earnings. The big volatile event is over. So we don't want to look directly at Snapchat, right? But what would, if Snapchat has bad guidance, or honestly, to play the other side, if Snapchat has good guidance, what other companies are going to be affected by that? What companies have similar user bases, similar business models and monetization models as Snapchat? So on a day where Snapchat went from 17 to 10, what other stock may have been poorly impacted on July 21st? And the answer is Meta. If we go to July 21st, honestly, I'm kind of doing this live. I didn't check this before, but there you go, July 21st. What do we see? We see it go from 183 down to 168, and that's before they present earnings. And the great part about this, right, if we remember that Snapchat chart that we pull up for that big drop, implied volatility falls off the face of the earth after earnings, which kind of kills option premiums. So the big move is mitigated a little bit by that. But if you look at something like Meta, which doesn't report until next week, they sustain that similar dip. However, option premium, implied volatility, it's still there. Let me back this chart out and I guess maybe show a better example where we include earnings in that. But again, their implied volatility and consequently the option premium didn't fall off until July 28th when they reported earnings. So you have this huge candle down and walk down to earnings without any loss in implied volatility. And we love, typically, as option sellers, we love when implied volatility drops. But if there's a situation where there's potential for a big move off of an event, meaning there's potential for a big move on Meta off of a Snapchat event, with no discernible drop off in implied volatility, to me that's a really, really nice option buying opportunity. Now I never want to put my chips on one side of the table or the other with these types of opportunities, because look, Snapchat could have bad guidance, Facebook could go down, Meta, sorry Mark, but they could also have good guidance and Meta can go up. So we want to play both sides of the coin here. And again, I haven't looked at this yet, so I don't know exactly what this is going to look like. But say you wanted to play this kind of social media type volatile earnings move, right? If you wanted to play it off Snapchat, you're going to have a very, very difficult time doing that, right? If you wanted to buy an at the money strangle on Snapchat, they're going for $1 a piece, these options that are dead at the money. That means your break even price, because the total debit would be about $2, and that means it would have to move past 8 or 12 for you to make money. So it would have to move outside of this range right here for you, let me zoom out, to make money. And again, we're looking at Snapchat over the past month. So to move outside of this range, quite honestly, that's a pretty large move. And if you wanted to capitalize a little bit off of Snapchat earnings, selling these puts right here is a very, very interesting value proposition. Down to 7.5, that's in the gutter. So that might be something we keep an eye on for the coming week. But back to the point of buying an at the money strangle, it would have to move outside of here for you to make any money at all. And again, you pay a $2 debit. So if you wanted to double that investment, it'd have to move $4, meaning you'd have to be outside of here or here for Snapchat. So all that to say is, in a very short time frame, while there is a volatile event like an earnings announcement, since that's priced into Snapchat, it's going to be very, very hard to take advantage of that. But where might it not be priced into? Enter Meta. So if we wanted to buy an at the money strangle for next week, assuming that there was going to be some sort of decent move in Snapchat, we'd be able to see that an at the money straddle is going to be roughly here-ish. It's going to be like $8. So 8 plus this is 134. 128, 126 minus 8 is going to be 118. So when we look at Snapchat, the 1 month chart, right, we see that we need this big of a move to make money. When we look at Meta, we have precedent set for the fact that there might be a decent move on Meta before earnings based off of how Snapchat reports. And we only need to move this much. And to contextualize, how small of a move that is, if you look at Snapchat's move, they haven't traded outside of this range over the entire past calendar month. If you look at Meta's move that we need, they were trading outside of that range last Monday. So, nothing we couldn't see happen here. So I really, really like the idea here of a at the money straddle on Meta. And it's going to be a little bit tougher. And what I really like about this is, look, there's a defined time period for this trade, meaning we're going to buy it that expires October 21st. And we know when the big event is, right? The Snapchat event is going to be Thursday afternoon. So we don't have to buy it right now because honestly, the only thing that would happen between now and Snapchat earnings is that it could potentially decay and we lose money on that. So we get in Thursday afternoon, 3:30, 3:45 p.m. We let the event happen. Friday morning, if it doesn't move the way we want, that's okay. Those options aren't going to lose all their value the way Snapchat might, because implied volatility for Snapchat is going to fall off a cliff because they've already presented earnings. Whereas Meta, we've already demonstrated that implied volatility, this was that Snapchat candle. Implied volatility stays relatively flat, so we're not going to lose a lot of value on that straddle. And while we love selling options, I think this is a really interesting example of having this sympathy event type long trade to allow us to benefit. And one of those things too, we talked about being a little bit of a little bit wary about earnings, how they might tank the market. If they do tank the market and it tanks Meta, we'll remember that, look, we make profit if it goes down below here, and further, we double the investment if it gets down to like here, or what's 8 plus 142, if it gets above there on the upside. And I definitely think that's something that could potentially happen. And again, right now, these are 5 days to expiry. That's why it's like an $8 straddle. Thursday afternoon, it's going to be 1 day till expiry. So in theory, it should be cheaper, meaning that these red lines get narrower and narrower. SpaziX in the Twitch chat. No problem. Thank you for joining us on the stream tonight. Appreciate you popping into the chat. But that's kind of my big dumb option buying idea. Every now and then I get bored and like do more research than is good for my own good. Is that how you say that? I don't know. I'm not going to try that sentence again. But every now and then I spend a little bit too much time in front of Thinkorswim and like come up with some stupid idea like this. But I think the way I've laid it out, it makes sense. We have some precedent for how implied volatility is going to behave. So I'm confident that we're not going to just completely have the position shit the bed. So kind of down here, I'm going to throw the wish list on there. Meta at the money, long straddle. Meaning we're going to buy a call, we're going to buy a put, same strike at the money. Thursday afternoon, whatever happens, happens. Friday, we get the hell out of that position. So that's what we've got right there. And again, everything else I really do want to hold off. We could quickly take a look at one of our scans where we use that beautiful intersect with feature. We've got high ROR puts without earnings. That's our bare bones basic scan. Let's take a sip of water while this thing loads. Okay, so you see right here, this is a good example of a false positive. Excuse me. ROR is 40%. Why is that? It's because Thinkorswim calculates the option price as halfway between the bid and the ask. The bid is 2 cents. The ask is 85 cents. More realistically, the most that option traded for was 10 cents. So this is not a good result. Ftse, that was a former SPAC. We don't want to touch that. EVTL, honestly, no idea what EVTL is. Vertical Aerospace. They've got weekly options. Some very, very nice premium on a weekly basis. However, there you go right there. Less than a month ago, it was trading at 563. We don't want to touch anything that looks like that. Anything else crazy? JDust. I think this is like a gold ETF, right? JDST? Yeah, gold miner. Why is that one going so crazy? There you go. It's because the price action on the stock is crazy. But look, you can get that 2% ROR that we like to look at for a half-size position at 13.5. I got to be honest, that's interesting. But I think the issue with these miners, if you look at them, there you go. They're one of these stocks that kind of like the way that the ETF is structured, inevitably just go down. So not really conducive for a long-term position. So not something we necessarily would want to get into. Carvana, 16.5 strike put. That company sucks. I don't want to touch that. Beyond, this is like one of those where, look, and I think I have this like verbatim in this blog post that I'm going to be publishing soon, but like if we think a company is going to go down, there's no need trying to race it to the bottom, right? There's no need for us to open a bullish position on something we think is going to go down. Beyond had a really rough week last week when they announced that they were going to drop a ton of jobs. Oops, just clicking live news. September sales flatten, inflation worries rise. CFO's leaving the company. Price target got cut to 13. To play devil's advocate, and the reason that I like kind of thought this was interesting is that like half size 2% ROR position could be found at 11.5. This is the 5-day chart. 11.5 can be found down here. That is just a massive cushion, but I think it's pricing in the risk that like something catastrophic is announced at beyond, and that they just completely fall off the face of the earth. And that honestly is not a risk that I want to get in front of. So leaving that alone, but it's, was definitely one that caught my eye, admittedly. Peloton's on here, we're already in there. Affirm is on here, we're already in that one. Let's go with the intersect feature to find which of these are, pretty heavily sold off, HT oversold stocks. Click scan again. We go from that list of 935 different options to a more focused search that gives us 7 different options. So we've got TSLL. We're going to run through this list and then we're going to call it a night, but see what we can do here. We know XPEV is like an EV company. This one comes up on this list a lot, and I'm actually curious to see what the chart looks like. Yeah, that's brutal. That is a horrid chart. But yeah, I mean, if you hate profits, there you go. But going back to this list we had on the scanner for the option hacker, TSLL, no idea what TSLL is. Let's look at the chart. Oh, it's the Tesla Bull ETF. That's horrible. Oh, that is brutally bad. Not touching that one. Is that TSLQ? I think was a like Tesla. There we go. The Bearish ETF on Tesla, which is, phenomenal investment in my opinion, because I'm not a huge fan of Tesla. But look at that one. That's very interesting. That's kind of funny. Anyways, back to Yin, I think is another one of those Asian companies. Nope. Yeah, Ftse China. Yeah, I'm not touching that one. Especially over the last year, this thing's gone from 266 to 32. Not great right there. That's a tough look for this one. It does have weekly options. The premiums are insane. The volume isn't through the roof or anything like that, but the premiums are insane because this chart is insanely bad. Woof. This is a new addition to the list here. Woof. Petco. All right. Let's go through the process here. Look, and the reason that we like this scanner is because it gives us the intersection of a couple things that we really like. The first is high implied volatility, which, relatively high compared to the past calendar year. And the second is low RSI. We love low RSI. Good Lord, get it together. We love low RSI because it is one of the best technical indicators for when a stock is going to bounce or at least flatten out in the short term. And as we know with our strategy selling cash secured puts, we don't need anything to fly through the roof. We just need something to stay flat or bounce. So with that in mind, 1040 looks like a pretty good entry point with the low RSI. It's already bounced off of 10 previously. Let's see what the premiums look like. And it looks like you could get about 40-ish cents, 20-ish cents on a 10 strike put, which is, let's think about this. Over the past 5 days, it's gone from 11.08, bouncing off 10 to 10.5. If you wanted the 10 strike put for like 20 cents, that gets you down to 9.80. I gotta be honest, I don't know if I love that, especially if we look at like the 20-day. This thing looks like it's going in one direction. Nothing that I'm, over the moon about entering into. VEEV, I'm already kind of wary about this one because of how high of strike it is, meaning you'd have to invest 15K. Look, that lines up, chart-wise, that lines up very nicely. Implied volatility nowhere near as high as it used to be, so not a huge fan of that. Just nothing great off of this list today, but again, I think we've got a really, really nice list outlined here with what we've got for the coming week. As always, look, as indicated by these purple new tags, there's always so much stuff that happens between Monday and Friday. So kind of to stick with us on those, come join our Discord server, hourglass-trader.com. And you can come trade and chat with us during the week as we talk about what we're going to be adding during the week. Because look, I think we've got a great game plan headed into the week where we've got some decent upside, right? Where we could take ourselves to profit of like, in excess of $7,000 if these all hit max profit. But similarly, we've got a decent cushion with $4,500 of base profit. And we could scale further in and, add some more positions to put ourselves in a pretty nice spot if the market does turn around. Camera 2, we are back. But that's all we've got for this week. For those of you who tuned in, thank you for watching and hanging out with us live and, engaging in the chat a little bit. For those of you watching the replay, we love you just as much. Thank you for watching the replay. You're just watching this in the future. But until next time, this has been the Hourglass Trader, where as time passes, we make money. Hopefully we'll talk to you guys again same time next week with more money in our account than we have right now. And I think I fully attribute last week's losses to us not saying that super corny sign off. So hopefully that gives us a little bit better luck this week. But again, important thing to keep in the back of your mind, not just this week, but beyond for the rest of 2022. We are in a historically bad market. It's easy to get discouraged if you're losing money. If you are discouraged from losing money, that's kind of a good thing, because it means you value your money, right? And valuing your money is going to get you where you want to be in the long term. But just hang in there. The goal when we trade in really, really volatile, tough markets like this is just to keep your head above water, because eventually, the sun's going to come back out and we're going to go on a little bit of a run, and things are going to be just fine, right? We had an awesome run in our account between May and September. We gave a little bit back over the last few weeks, but no reason once things start to mellow out that with the same approach that we put forward for those months that we can have a similar run into the back end of the year. Goal number one is just to get profit. Overall goal is to outperform the market, and we've done a great job of that so far this year. But, stick with us. We got a couple more months to go, and hopefully, once the end of the year rolls around, we'll have some good news to report. But until next time, thank you guys for joining me. And, see you guys next week. Thanks.